pretend like I know what I'm doing. And then when I hit that button should do that. And then we hit that button and we're live. See? I could do this all myself. Welcome to the Closing Beat, everybody. Happy Tuesday. Is this year gone by fast? I was just laying on the floor back there thinking, this year's gone by really quick. Very impressive. Hope all is doing well. All of you are doing well, and all seems to be going well. Got this thing going, man. I got this thing. There was a time when it was just me in a little warehouse, just making videos and stuff. I still got a little bit there. Before I get started, actually would like to say a huge thank you to Mr. Dennis. We won't use last names here, but Mr. Dennis brought me a ball that he got signed to me. So made by Rod Carew, Hall of Fame, 1991 there. He, I used to follow the Minnesota Twins because I went to their spring training as a kid and got to know Kirby Puckett down there. And so we were talking about that, and he just went down there to see him. So I don't know what you can see there, but totally cool. That's going on a shelf back there, which this is not a green screen, by the way. Sorry, Dave, we're going to waste a little time. Not a green screen. I'm actually going to hang it up there. One second. Right there. Okay, sorry about that. Just wanted to say thanks, Dennis, and thanks for stopping by. He may have also brought us something to drink, and maybe some of that has already been utilized, but appreciate that. We are financial advisors here at Jazz Wealth, and as you see at the bottom, we are going out for business. Not going out of business. It's a trick. See what I did to you? It's a play on words. Anyways, I hope you'll keep us in mind at jazzwealth.com. And you can also go to jazzwealth.com/2023 if you'd like to just have a little two-pager about all the numbers and things that have changed this year for 2023 as it pertains to your dough, not just, random stats and stuff. So I hope you'll check that out. Do appreciate all the feedback, and if we can help you in any way, you could schedule a call. Eric is currently taking the calls there. He's happy to help you, point you in the right direction if we're not a good fit, and all that will be good. It's not a green screen, right? People used to say, you're just some kid in your parents' basement or something. Now you know. It's not a green screen there. I love it. I love it. Let's talk about the stock markets here today. Bit of a wild ride, huh? Remember we talked about yesterday there needing to be a catalyst. We had hit the 50% area there from the lows to the highs. And we said the glass is half empty or half full. Depends on how you feel that day, right? So we need a catalyst to convince people to continue to buy or to take some profits, or maybe like we're starting to set up here, just to chop around back and forth and keep that volatility just a little bit higher. So that's what happened today. We had Mr. Jerome Powell out there. The stock market said, we don't like you. No, quit saying things about higher rates. And he actually was pretty much single-handedly responsible for starting that sell-off. And then you notice some people jumping on the bandwagon or whatever later, which pulled the markets lower. Bond market, really interesting today. I don't talk about bonds often because they're kind of boring and not a lot of people like to participate over there. But as they get more attractive, maybe that's something that we'll start to talk about more. I noticed the one-year Treasury bills hit 5.25%. Okay, so we talk about raising rates, everything. Oh, we're going to be stronger on rates for longer. It's going to remain higher, more elevated for longer, all the words that he said. The 1 year starts creeping up, but the 10-year went down, at least at that point. We'll cover that in a second, but it started going down. The stock market usually responds to the 10-year, right? The 10-year rate starts going higher. That's weaker for stocks. It really didn't move that much. What's that tell you? It tells you that people are pricing in higher rates in the short term, but then this is like the peak, right? The perception is we're pricing in these higher rates, but not from 10 years. No, that's not a problem. Not even 5. It's just for right now. And so the 1 year actually hitting 5.25 is pretty interesting. 2 year hit 5%. First time, I believe, in about 20 years. Give or take like 3 years, somewhere in there. I gotta go way back to recall seeing a 5% on a 2 year, but it's what it is. I just thought it was interesting that the 10-year actually went down there, when usually that's where we're focused. And so, no, today was sell them if you got them, right? To the stock market anyways. Sell them if you got them there. Now, one thing I want to point out, the Fed had some very strong words to say today about, well, we're going to fight this thing. We're going to get inflation back down. We remain data dependent. That's the takeaway. Why did the markets rally in January? Because the data suggested that the Fed may have to pivot or stop raising rates or just pause or whatever. Turns out the data was just a little bit early on the data there, right? And so that's why we have the sell-off. What's happening now? Just the words pull the market down. But if the data, which by the way, next Tuesday we have inflation numbers coming out. So if next Tuesday the data suggests that all is going well and inflation is coming down, we're doing a good job, that right there could cause a rally. So, I mean, that's why I kind of mentioned a second ago, when we look at the market here, we're probably setting up for some chop inside of a wide range, not likely a big rally or a big decline, just a lot of chop. Because we had Powell say one thing, we have the data that could say something completely different, which means that Powell would have to start changing his tone. So remember that at the end of the day, it's not how Jerome Powell woke up and felt about interest rates that day. It is data dependent, and he's sticking with that. Well, they always stick with that. So key focus now, and that gave you the hint, right? So he basically threw that out today and said, this is what we're doing. However, don't go anywhere because the data next Tuesday could tell us something different. So although there was a lot of pessimism out there, keep in mind what they've been saying. And this goes back now a week and a half to where we had some of the first Fed members come out and say, we may have to be tougher for longer. They do that. They do a great job of actually setting the tone for what is likely going to be the big, narrative or whatever their focus is. So they've been setting the tone for that, but data dependent. That's the big one there. And Tuesday, of course, we get the inflation numbers as they come out. I just wanted to point that out because I saw a lot of negativity and I'm like, well, wait a minute. Yeah, of course, he's talking tough. He has to talk tough, right? But the data could change his mind. So there you go. All right, let's look at the stock market here. So the S&P, we know we're probably setting up for a little choppy range here. The S&P now only up 3.83% year to date, and every sector today was down. Every one of them, and by the way, every one of them was down by at least 1%. Consumer staples lost the least, down 1%. Communication services, down 1%. It only gets worse from there. You work your way all the way down to financials, which lost 2.6% on the day. Financials not participating in this rally. Really interesting that financials are not participating. And by the way, side topic, it's going to get worse. Because tonight on Jazz After Dark, I'm actually going to go through how the financial sector is getting changed, and so is the tech sector, and so is consumer discretionary, and so is consumer staples. They are literally going in and saying, well, let's move it this way. They're going to take from the sector that's got a lot of say in the market, and they're going to go put it over here so that everybody else has a better or bigger say in the market. Really interesting change coming up that I don't think anybody's even mentioned yet, but this is happening next Friday. So Jazz After Dark tonight, we'll cover it, and I've sort of normalized and visualized the way that that's happening so you know what's going on. You got PayPal, Visa, MasterCard, you got Paychex, ADP, you got Target, Dollar Tree, Dollar General. They're all getting moved. So really big move there. Hopefully hopefully I won't make it too hard. It'll be really crystal clear there. Also, Cody was not here today, but in the in the tech sector, we talked about doing this. We'll do it tomorrow, I promise. So we have the 50-day crossing above the 200-day moving average. Technical traders like to look at that. What we're going to do is we're going to look at all times where we had this, quote, golden cross, that's what they call it, versus all times in the market versus any cross of moving averages. So all of you that are curious, like, is that something I can use? Can I make some money when there's a golden cross or the death cross? We're going to go through the stats. I'll make it really simple so you can see whether the technical traders are right. And I'll let you guys guess whether you think they're going to be right or not. But Cody wasn't here. I couldn't get my chart made up. Anyways, moving on. So we got the NASDAQ, still the best performer here year to date. Of course, saw a little weakness here today. Still up double digits, 11.08% year to date. So still doing well. There's going to be a shift. Remember, next Friday, there's going to be a shift there that will change it'll change how much volatility you get in the NASDAQ, just ever so slightly. I don't want to mislead you there, actually. Russell 2000 really took it hard yesterday. So yesterday, if you notice, markets were up. Russell 2000 straight down, man. Had a horrible, horrible day. Small caps getting sold really hard here, and they just got bid up, right? They were one of the leading sectors, and for a brief moment in time this year, they were the best performing index, not sector. I just said sector. At the moment, they remain up 7%, but rapidly giving back their gains. Let me go over here real quick. Gold pulling back sharply here today, and if you look around, of course, that's going to be rate sensitive there, and ta-da! There you go. The dollar took off. See that? Big, strong dollar here today. What does that do? That impacts of course, that impacts the price of gold, but it also impacts what? Companies that have more U.S. sales than more international sales. So we covered that yesterday if you're interested on the details there. It's something I've been touching up with and trying to keep educating as things happen so that you can learn as things happen instead of learning from history, right? If you can identify things in real time, make you that much better of an investor, trader, fund manager, whatever you want to call it there. Okay, I want to go over to oil here real quick because I think I can get away with saying this here. I am bullish on oil. I think you need to find your opportunity to be bullish on oil, and it's closer than further away, which I think I'm allowed to say because I'm watching these people on TV and they're advisors too, to some degree. I'm like, okay, I'm not telling you to buy it. I'm just saying I'm optimistic on it. And I'll give you a really unique reason. Do you often look at the price of something and say, well, it's either fundamentally a good stock or it's technically a good stock, right? We've gone over that. And remember, fundamental analysis tells you why you may be interested in buying something because it's growing and things are good. Technical analysis tells you when you might want to buy something. If it's up 17 days in a row and you find that that's good, strong, fundamental stock, well, you may not buy it right there. You might just say, well, let me get a little bit of a pullback. Well, here we have oil prices that haven't risen, 3 months? But we have all around the world really sharp sort of raises in GDP growth. China in particular, who's the biggest consumer of oil? China. So you have these big surges in not only demand now, but demand in the future, because we're using futures here to talk about this. And yet oil has not gone up. What's going on there? You can assign all kinds of news there, but there's something that hedge funds use and mutual fund managers and anybody, analysts, is really geeky in this. There's something you can use that is called now I don't know if this is like industry term or if there's something better you could call it, but the daily shock. I didn't invent it, right? So there is something that we follow in oil called the daily news shock to the price, both now and in the future. And when we're talking now, we say spot. And when we're talking in the future, we say future. Right? That's why futures exist there. So a spot shock, news-wise, would be something like a hurricane. It's a freak event, right? It just comes along with freak event there. Rapid changes in the economy, right? Could be something there as well. That affects the price of oil immediately. And we measure how rapid that impact is actually happening. That's actually a tool that people use there. And so typically, that's an event that'll last a few days or a few weeks. And I'll use the hurricane as an example. Hurricane comes through, we shut down refineries, supply all of a sudden gets a little bit tight, prices go up, right? You get the concept there. The news event causes volatility in oil. Future shocks would be things like OPEC cutting their production. Hey, we're going to cut production in December of next year, but for now, we're going to keep it going just as it is. That'll be, something that we can look at in the future there. It could be any kind of stimulus in any given country. I'll use the U.S. as an example. We could be trying to stimulate the economy by, they throw the money out of the helicopter sort of thing that they do. And this is a little bit of a lesson, so I'm just talking for a second. When COVID hit and they're like, here, have a bunch of money, go spend it. Okay, well, that can impact prices in the future. Not right away. You wouldn't see oil just take off. So you get the difference there between what we call spot and future impacts there. Here's the trouble. Oil prices are 4 times more, oil prices are 4 times more, I don't want to say volatile, I'll say responsive to any shock that's happening now and in the future. Okay, so you can identify that and say it's 4 times more volatile, or compared to like a 52-week range. And so what we have is supply decreasing day by day because demand is there, demand is there, demand is there. But it is yet to become a news shock, both in the short-term spot or in the future. Well, when that starts to hit, what happens? People go, oh, oil, that's duh, I should be investing in oil. Wow, GDP's going, all this stuff is doing really well. That hasn't happened yet. But since we know when that news event hits and it starts to become real popular, like your 3D printing and your pot stocks and all that, when oil gets exciting. They seem to like have cameras outside of the OPEC meetings and things like that. That's 4 times more action that you see in oil. Well, there's no catalyst to cause 4 times more action to the downside. It doesn't exist. There's nothing on the horizon. You can't have all this expansion over in China, I should say reopening in China. You can't have all this supply going away. You can't have our petroleum reserves going away. You can't have the war being over right away. So there's very little downside shock, which would be a 4 times expectation of above average volatility and move. But you have all kinds of things for that shock to the upside, both now and in the future. Sorry, that's what happens when Cody's not here. I hit the wrong button. So anyways, long story short, you take a look at oil and say what hasn't moved despite all this growing pressure that would inflate prices. But it hasn't fallen. No selling price. No one wants to sell oil. So the actual holders of oil at the moment, futures contracts, realize, well, I'm not letting go of this. There's little downside risk. But there's all kinds of potential upside risk, or FOMO, I guess, if you don't own it. And so that's what's going on there. That's your lesson of the day. Whether I explained it or not, that's what you get. One other lesson here, because, I like you guys. You know what I mean? In the options world, I try to update you guys on this about once a week here. The average S&P stock implied volatility has dropped 3 points since last week. However, it's still elevated. It sits at 25, the implied volatility, which puts it in the 57th percentile. So it's above average, if you don't want to sound geeky. So what do you have in the options world? If you're a seller of options, covered calls, naked puts, whatever it is that you do, you've got higher than average implied volatility there and no real catalyst up till the next expiration. See what I'm saying? You got greater than 95% of the S&Ps already reported their earnings. So on an individual stock basis, you have no real problems there. In other words, it's a good time to be a premium seller still, if you want to do that. If you use the skew versus the index measurement there, you can actually see the appetite for call buying is higher. So someone who owns stock and wants to sell calls, you're going to get just a little bit more for doing so there. And on our research site, jazzwealth.com/research, I'm going to be posting a list of overbought stocks and oversold stocks with the total yield that you would gain from selling a call, presumably. I'm assuming that's what you would be doing there. For each individual position. So you get an idea of like, is it worth it or not? So I'll break that down and post that a little bit later tonight. I'm sorry, I rambled too much there. I do apologize for that. Let's start with some stocks in the news here. You got Thor Industries. This is a big miss for them. You guys know what Thor does, right? Do I need to explain? Very cyclical. And most people were like, people are still spending money on this stuff, traveling like crazy and, hitting the open roads and all that. They missed by about 50% on sales. And I put down some of their quotes here. Management said, where was it? The CEO said, near-term softening in market conditions, which were also met with reduced production rates and extended holiday shutdowns there. We see a significant retail pullback. That's called a kitchen sink earnings report there, where they just throw all the nastiness at you. And hope you go for it there. It's still not bad. It's been an outperformer, but that may be the end of that ride. Dick's Sporting Goods, they're in the retail space. They're like, we didn't see it. We have stronger earnings. We have stronger sales, and we're even going to double up our dividend there. I believe they doubled it. They did actually double it. So they're not seeing the same thing, but good for them. Rivian needs more money. They say, well, we're going to have to raise another $1.3 billion. We've got $12.1 billion in the checking account, but we're going to need another $1.3 billion there. And they're going to be selling convertible notes that would convert, I believe, to bonds. The bonds that have to go out to like 7 years probably. Anyways. And then you have this Weight Watchers. Now you got to call them WW, but I think, we know what they do. They now want to get into, so they bought a platform that's like telehealth, but mainly for the ability to prescribe weight loss drugs because they can't currently do that. You know how much money that means for them? If they can do this and execute this thing perfectly, you know the type of money they're about to make? That's why the stock is up. Meta, not really a mover here today, actually, kind of an underperformer relative, or an outperformer relative to the market there. They're going to be doing another round of layoffs. It's only been since what? November, December, January. It hasn't even been 4 months since they started their first round of layoffs there, but going to be cutting back there just a little bit more. All right, Jazz After Dark. Last night we talked about Social Security and taking that early. Tonight we're going to talk about mutual funds, ETFs, retirement accounts, and the positions inside of them, all changing on March 17th. I will go through that with you and try to explain in great detail what that means for selling pressure in various sectors of the market, and what that may mean for you. If you're someone who is heavy in the tech sector, you're going to find yourself all of a sudden overweight the financial sector. And you're like, what happened? I was in the tech sector. I wanted to be in tech. Nope, you got your financials now. So going to be an interesting move there. I'll try to take your questions here if I can. Can I? Let me refresh this. Sorry. I'm coming. So refresh this guy here. And then if you have a question, feel free to ask. I will see what I can do and come on in and help you there. Pop this guy out. There we go. All right, let's see what we can have here. Think you're in a new Cold War? This big question's been asked for like decades now. It's just that, there's always like, oh, man, we don't like you guys. We don't like you, North Koreans. We don't like anybody. And then it just kind of goes away for a while. And then it comes back. So, oh, you're spying on us. No, we're not. I don't know. I don't follow that stuff. You got some Thor in there. Well, it may not be the end, but they, consider what happened today with that kitchen sink type earnings announcement. That's the worst that it could do. It's not bad, So good time to buy financials. I just bought yesterday. Well, I bet you wish you'd have bought today, but maybe not a bad deal. You're going to get a few extra stocks in your portfolio from buying the financials. You may find yourself more overweight financials than you want to be after next Friday. I love it. What is Thor? Yeah, I only know because I'm from Florida. We're here in Florida. And if you get on any interstate, it's like RV park, RV sales company, or RV distribution center, RV repair station. It's like, we see them everywhere. So it's Camping World. Oh my God. I think we even have a Camping World stadium in Orlando. Top 10 holdings. Oh, I missed your question. I'm sorry. You like the rambles? They tend to be educational. Okay, good. I don't mind rambling. Plus, you can just turn it off if it's not good for you. You know what I mean? People love to retire in Florida. You got to watch them real estate taxes, man. We're getting a little grumpy down here in Florida. These real estate taxes jumping up on us like that. Moving your HSA. Oh, yeah, that's cool. You got the email. Perfect. Yep, that'll save you a few bucks. Is JEPI a good investment for income? Any of those covered call type ETFs, you want to know how they sell covered calls. Do they sell covered calls right at the money, and therefore the stock will not move much higher, or the ETF won't move very high, but it will participate on the move down? You may not like that. Do they sell covered calls that are 20% out of the money, 25, 30, 33? Where do they stand there? And then also, you're attracted to an ETF like that because of the dividend. How is the dividend taxable? Assuming this is in a brokerage account. Is it taxable as ordinary income or long-term capital gains? You might find that you don't like the type of income that puts on your tax filing. Yeah. What's the deal with some banks offering higher interest rates while others don't budge? I don't know. So you have a handful of banks that have committed to no longer doing commercial loans. This is a poor example, but they've said, we don't need any more of that on our balance sheets. We think it's too risky. We don't want to do it. Therefore, they don't need to bring in a whole lot of money for that. So it may not be attractive to them to offer higher rates to bring in dollars to then lend out to people they're not even willing to lend to anymore. So times that by all the banks that maybe they say, we're not going to do car loans for a while because we're finding that prices are too high. We're not going to do home equity lines of credit because we're not sure about the housing market. It could be things like that. Yeah. SoFi was one of them that did ask to, for goodness sakes, let people start paying their student loans back. They were one of them. That is correct. I think that's clever. Can you imagine the phone calls? Because you know they had to get together on that. It's not coincidence that those 4 companies go to the White House and say, please. That's not coincidence. They had some phone calls. Hey, you in if we go down there and ask Biden to do this? You know? And I mean, is enough not enough? Like, let's go. You can't say the economy is doing so well on one hand, but yet we can't let people pay back their student loans on the other hand. It's a little bit tough. You can drive some inflation if you make students pay their loans back. Yeah, it'll do the trick, wouldn't it? That's a good point. Yeah, I've never thought to say it that way. You want to suck up some dollars out of the world, man, or out of the U.S. That's cool. All right. Not bad. I think we actually, maybe did better that Cody's not here. I'm just saying. We want him back. Maybe he'll be back tomorrow. I don't know. We'll see. Also, he may not be a closing beat on Thursday. Sorry. It's supposed to be going out of town. I don't know how I'm going to get there, if I'm going to be there in time. So just a heads up. But we'll be back tomorrow. We'll do this all over again. You enjoy the rest of your evening. And I'm going to hit this button for real this time. I appreciate you watching.